Welcome back to Everything Money. We're glad you joined us again. This is Seth, Paul, and Mosef talking stocks. Today we're talking about Discovery, DISCA. Discovery is one of the largest global media providers with 2 billion subscribers in 220 countries. They have Discovery, TLC, Paul.
How is it possible to have 2 billion subscribers? Because then it says 84 million households and more than 200 million international subscribers. This is like HGTV and Food Network. I love HGTV.
I watch
Can't stand Food Network.
Naked and Afraid is my show. We cuddle up around the fire, cuddle up as a family.
Do you?
Oh, I watched every episode. All the
Have you really?
I love my kids love it. But that's not what we're talking about today. We're talking about the stock price. This thing was a banger last year. It was a little book stock, the Joel Greenblatt little book that beats the market. I was in this puppy and feeling great about it during this run-up, Paul. I mean, an enormous
Seth
run-up.
was walking in with suits on with $100 bills just attached to them because of the stock.
Rollies and yes, all because of the stock.
8 watches on.
The $5,000 I put in this stock. And now, Paul, I was sad. By the end of the year, this thing tanked. And we'll go over why, the who, what, when, and why, and what's going on now. Is this stock a buy at the moment being slow? There's a fine line between this, Paul. It's like we obviously sway our viewers from paying too much for overhyped, overpriced stocks. But when they're down far, is this now a time to buy? We will tell you right now using our software. Go ahead, Paul.
All right, so first off,
Go ahead.
please follow us on Instagram because my life goal is to get a blue check mark.
Go on.
So remember one thing, Seth. You look at this big run up and people are going to sit there and say, oh, look, the stock is down so much, it's a deal. Guys, I hate to break it to you, but just because a stock falls doesn't make it a good deal, right? Mm-hmm. Just because a company falls in half, if it's not worth what it was selling for, it might, or even half price, it's still going to go down further.
Do you remember what that run up was? They were a part of that short squeeze.
Yeah, with the Reddit people, weren't they?
Yeah. And then they had the Archegos.
Then they had the Archegos thing happen.
They've had an interesting year.
So if you don't know what Archegos is, go look it up. It was, when everybody talks about rich people being very smart with investing, guys, rich people are no different than you. They made their money some way and they still squander it in other ways. So go look at the story. It's insane. What was that? $8 billion family office, essentially.
Yeah, and they came out with like a $30 to $35 billion margin call on one day. And
something crazy. I don't know the exact story of it, but
nuts.
The stock has fallen, immensely fast right here.
Yes.
And I had some shares. I didn't have some shares. My ex-girlfriend had some shares.
Yeah.
But guess what? We bought the shares back here. So it was looking awesome. Then it fell. But I think it's still up from where it was at the beginning of the year, which is fine. Yep. So let's go look at this company's overall.
What's the market cap?
$14 billion market cap. A PE of 14.38. That's a check mark. And guys, we are changing the pillars just a little bit going forward, so please watch our videos. The new pillars are incredible. I love them even more than I love these ones. This is going to be great for understanding the health of a company. Profit margin only 9.1%, so it's a little bit lower than we like, but that's okay. No dividend being paid. Free cash flow looks very consistent, Seth. Last year, $2.3 billion. 5-year average, $2.2 billion. A low return on assets and return on invested capital, so who knows?
How about pillar number 3, which is revenue growth over the past 5 years, Paul?
So revenue growth over the past 5 years, 6.24 to 10.55. Wow. Now here's what I'm gonna suggest. It's a check. But looking at these big jumps and then flattening out, something tells me there were acquisitions along the way here. So go make sure that the growth is not just through acquisitions. We wanna find natural growth from a company. It's actually down over the last 3 years, so something to keep in mind as you look at it. Just because a company isn't growing doesn't mean it's not worth something. If I could pay you $1 a year for the rest of your life, that's still worth something today. If I paid you $1 this year and then decrease it by 1 penny every year for the rest of your life, that's still worth something today, even though it's declining. So don't get caught up too much in the I must buy growth. It's just that if it's declining, you need to pay a cheaper price. That's it.
Now, I would be remiss if we didn't bring up the merging with AT&T, Paul.
Yeah, so it's a merger or it's a... What is it?
It's like a spin-off.
Yeah, it's like a spin-off to it.
Yeah.
Yeah. AT&T has agreed to merge with Warner Media.
When's that going to happen?
$43 billion deal to combine the media powerhouses CNN, HBO.
So my opinion on that, guys, is these transactions can be complicated. There are some great value investors out there who make a lot of money looking at these spin-offs, looking at mergers, looking at acquisitions. That is not my area of expertise. I'm more of let me wait to see where the dust settles and then make a decision from there. That is my opinion. Does it make me right? We have over 5,000 people in our Discord and Patreon group who I'm not going to be the best investor out of all of them. There's going to be somebody who's going to be really good at doing it this way, but it is not my area of expertise, but it doesn't mean that you shouldn't do more research on that.
And we'll continue that with pillar number 4 is profit growth over the past 5 years.
So the profit's been kind of weird, Seth. 1.15 to 982, that's an X. It lost 500 million, made $1 billion, made $2 billion, so it's kind of all over the board. I don't know. They have more revenue, but less profit. Kind of a little concerning, but let's see why that is. Some other income and expenses at the top, but not, I mean, some big numbers. Boy, look at this one. They lost $2 billion that year. They lost 560. That might have been a one-time charge on a write-off. Anyways, go ahead.
How about shares outstanding, which is pillar number 5?
389 to 495, X. They probably issued shares for an acquisition. And look, since then, though, their shares are going down in the last 3 years. So guys, the shares are up over 5 years, but I think there were acquisitions along the way, and now they're going down. So keep that in mind when you're looking at it. Well, guys, so first off, the reason we created the software was because so many people were asking us, what software? Where do you guys get the software? So we created the software. It's awesome. We have an app now. You get the 8 pillars, 30 years of financial data, stock analyzer tool, daily content that we're going to be making only for the app, access to us 3, real estate calculator, retirement calculator, Discord community, over 5,000 people in our community, split amongst a lot of chats, very organized. You can talk about your investments. All this is included for the easy price of 84 cents a day, less than a crappy cup of coffee.
Yep.
Our competitors, $200 a month, $35 a month. Which one would you rather have?
If you're interested in joining the Patreon, you can click the description below, join today, and have access to all this wonderful software as we keep going with discovery, current assets over liabilities, Paul, and we're changing this pillar to...
We're going to focus more on long-term liabilities, how much long-term liability, and we'll look at it right now too, but right now the current assets, 5.9 billion, current liabilities 3.14, check mark. Now our new metric is looking at long-term liabilities at 18.26 relative to their free cash flow. We want the 5-year average free cash flow divided by total liabilities divided by the 5-year average of free cash flow to be less than 5. So right now 18.26 billion, the average 5-year free cash flow is 2 billion, 18 divided by 2 is 9. So it has too much debt for what we want in our metric. It just shows overall debt levels. It would take 9 years of them taking all their free cash flow they've done the last 5. It would take them 9 years to pay off all their debt. Is that good or bad? Well, it's above the average in the market right now. Okay, so that's where I look at it. The great news about this is it's not really driven by the stock price. It's purely driven by the company's decisions. What's their free cash flow? What's their long-term liabilities? In terms of free cash flow, 1.45 to 2.3, check mark there, okay? With an average of 2.2. They had 2.8, 2.8, 2.3. The 2 years here before the acquisition, 1.4, 1.5. I would focus more on the free cash flow here. It's a lot more consistent than the earnings. If you saw at the top, first line's always earnings. It was a lot different situation here. There was a lot of different numbers here on the net income. So things to keep in mind already over here.
Pillar number 8 is price to free cash flow. So we'll take our free cash.
2.2 billion times 20 is $44 billion.
Wow.
What's the current market cap?
14 bill, Paul.
Wow.
14 bill.
Okay, so guys, it's funny. I was sitting here going like, oh, this thing sucks, this thing stinks.
Wait a minute now.
Now I'm looking at going, wow, only 6 or 7 times free cash flow. Guys,
this is not slowing down. They just launched Discovery now. They're launching their
They have a lot
service.
of debt though. My biggest concern is the debt.
They're picking up more TV shows.
Because if you look at their pillars, look at how bad this is. Oh, it's actually not that bad. Not as bad as I thought.
Go on.
But their debt is not good. They have $18 billion in long-term debt, over $2 billion in free cash flow. It's 9-year payback. That's not, it's not more of a what's good or bad. It's more of a keep this in mind.
Yeah, how often do we have companies where their debt is more than their market cap? Is that rare, or am I seeing
that's probably pretty rare. I could do a screener through our software and figure it out, but man, only 6 or 7 times free cash flow. So you have to understand, you have to decide and they're buying back shares. So this one is where you do more research. What's the more research you do? 1, what's their share buyback plan? Because I'm quite sure their shares increasing were because of acquisitions. 2, what's their plan on their debt? Is the debt increasing? Is it because I know that AT&T deal was a debt deal as well. So maybe that's going to help the company. I don't know what's going on with that transaction. I just look at this saying that price of free cash flow is extremely, extremely appealing. Talking about literally 6 or 7 times, less than 7 times free cash flow. That's pretty hard to find these days. But find out what they're going to do with that cash, because that's $2 billion a year in free cash flow that's hard to ignore. Even with that earnings fluctuations up and down, but the free cash flow is very consistently going there.
If you like trade, I'm sorry, Mo.
It was the same reason we liked them in 2020. It was similar reasons. I mean, it shot up, came right back down, and it's like we're having the same conversation that we had.
Mo's going to head over to the trading charts. If you want to trade this in a more exciting manner, you can join the BidNAS Nation, and Mo will teach his rules on how to trade stocks like Discovery. Go ahead, Mo.
So I really like. So this is the last 6 months. You had that big decline, and then it just became a dog stock, and it's just coasted along the bottom. And I really like what I'm seeing here. This 3 right here, that little thing. I always say, wait, if you're doing a long-term trade, wait for 3 days of being in the sweet spot. And here you got 3 days of being in the sweet spot, and you switch right back down into below the sweet spot. So that's why I always say, guys, you need confirmation before you go at these things. Everybody says, well, it's in the sweet spot. Can I buy it? It's day 1. Well, no, because this happens all the time. You get 3 days in the sweet spot, and then confirmation does not work, and it falls right below. So this is a great example of that. I'm going to make a learning video for the BidNAS Nation on this. But this downtrend, I just think it's going to keep continuing until it gets good volume. This little blip right here of 3 days and then falling apart, not good. It's below all of its major moving averages. The volume's terrible. It's just a bad situation for them right now. You're going to need volume to come in there buying for you to go to the top side.
You're not even messing around with this thing at the moment.
No. My only concern right now on the company is the debt level.
Do you want to use the stock analyzer tool and see what you want to pay for this?
Yeah, I mean, it's going to be way higher than it is today. But I just think we'll use the stock analyzer tool anyhow. But I look at the debt levels, just thinking to myself, okay, let's be conservative on growth, -1, -2, -3, 8, 9, 10.
This tool you get as a patron. You get access to the stock analyzer tool. Paul's inputting some assumptions moving forward about what we might want to pay now. And in terms of if we buy the stock today over a 7-year return, what can we make on it?
And I'm hitting the analyze button. I mean, it looks pretty good. I mean, how do you fight this? It's at $28 a share. I mean, we're pretty much 5 of the 6 numbers here are pretty. But again, the debt level is the hard part. Companies go under because of debt. You know what I mean? It's always the thing we haven't really discussed much. And I don't want to get too far into it because there's so much more to debt, but looking overall debt levels being 9-year payback on that debt, maybe it's good, maybe it's bad. It's above the average. It's above the median for the S&P. I don't know. I'm just...
For those of you due diligence people, this is when you go do your due diligence.
Correct.
Not waste your time beforehand.
If you don't want to do due diligence, fine. My advice to you would pass then just because of the debt levels. Unless you want to go really understand the debt levels. Because that price of free cash flow is very, very appealing. But that debt level, I mean, that's when companies get in trouble is because of debt levels. All it takes is a tightening of credit. Look at Blockbuster. Mm-hmm. People don't realize about Blockbuster. People always criticize Blockbuster. Oh, Blockbuster was actually back to cash flow positive. And then what happened? The credit crisis happened and they couldn't refinance their debt. They went under. They were back to cash flow. But then the credit crisis happened in 08, 09. They couldn't refinance their debt. They went under. Those are the things that happen. Even though Blockbuster, you might sit there and go, oh, come on, Paul, Blockbuster. Blockbuster was back to making it. It was back to competing. It was doing well, and then, boop, credit crisis happened. Who wants to refinance our debt? We don't want it. We don't want it. Why? Because that's what happens in the swings of debt. People love debt, and then all of a sudden they hate debt, and you can't get anything. I remember during the real estate crash, we went from getting 85% loans in Ohio. In literally a year, it went to we're not lending at all in Ohio. Why? Because there are too many foreclosures. Massive swing in 1 year. From 85% loan to 0, we're not even going to give you debt. So that's the way to look at it.
Yeah, Discovery is no longer a magic formula investing stock pick anymore. So,
yeah, their return on assets was very low.
Yeah.
Yeah.
Anyway, that's our take on Discovery. If you want the software, join the Patreon. Join our live streams, Mo in the morning and Tuesday afternoons. And follow along if you're learning. We'd love to have you. And we appreciate you fondling that thumbs up if you fondle Paul's belly.
And follow my Instagram account and follow me.
Please do. See you guys. Appreciate it.